Hello, this is Mike Swanson. I run the website WallStreetWindow.com, and the odds are that you're watching this video because you got an email from me telling you that it's on YouTube for you to watch. Now, if you're not on my free email list, scroll into the description for this video and you'll see a link to join. And then 5 days a week in the morning before the opening bell, you'll get from me an email with my market commentary and links to what I believe are the most impactful stories of the day that you need to know about. Now, have seen a dicey situation in the stock market. Last week, we essentially had what amounts to a failed rally as the market tried to hold the lows of the week on Monday and then bounced a little bit, and there was hope that that bounce could lead to a bigger rally if we could take out the short-term resistance, but that all failed. And on Friday, we had what amounted to one of the worst days of the year for the stock market. The Dow fell 900 points, and a lot of stocks actually made new 52-week lows. Stocks such as Google, in fact, stocks such as Facebook and Netflix. In fact, Netflix crashed in the middle of the week in one single day, fell, I can't remember, it was over 25%. And then Friday, it made even lower lows. So it was a week of intense selling and a lot of support levels were taken out. But yeah, I see this as confirmation that we're actually in a bear market, but that doesn't really mean that the stock market is going to crash. So let me show you the charts I'm looking at. We can figure out what the trends are, how this is likely to play out, and more importantly, what is actually the best place to put your money to make money, because there's always a bull market somewhere. Even when the Nasdaq is weak, there are other things going up. So let's look at the best places to make money, because that's what we're all about, beating the market. And to beat the market and be a winner in the financial markets, you need to do two things. First of all, you've got to align yourself with the big trends, and we'll show that in the video. And then second of all, you've got to be in things beating the market. You want to be in sectors, stocks, even entire asset classes that go up more than the stock market goes up when it goes up, and don't fall as much when the stock market has down days and declines. That's the secret right there. So let's drill into some of these charts and see what's going on in these markets. Well, this is the Nasdaq here, and how things look as I'm doing this video on Sunday morning. And you can see failed rally. Really the rally broke down on Thursday, and there is intensive selling on Friday. Now, the last weekend, I was making a note of the two pink lines on this chart. Those are 20-day Bollinger Bands. They measure stock market volatility. And when they tighten up and come close together, which they were doing last weekend, it indicates that you're in a pause in the markets, and then you're going to see an intense move. Well, that intense move turned out to be to the downside. We really had, a Tuesday rally. They tried to hold Monday, Tuesday, it bounced, then failed to take out the highs of the previous week, and then slammed down. So the trend is down as we look at this chart, but that downtrend, of the past couple of days is linked to a much more important downtrend, and that's the simple fact that the Nasdaq, and this goes for the S&P, the Russell, ETFs such as ARKK, they're all trading below their 200-day moving averages. And in New Year's, that's when the market as a whole rolled over. Now, a lot of stocks had actually peaked out from February to June last year. That's when the Russell 2000 peaked out. That's when the ARKK peaked out. That's when so many popular fad stocks peaked out. So they're falling way before the stock market averages, way before the Nasdaq and S&P 500, that is. They were already below their 200-day moving averages around Thanksgiving. And so, in other words, most stocks were trading much weaker than the stock market. Now, the stock market averages were being propped up by some stocks inside of it that heavily weighted, such as Facebook, Amazon, Netflix, Google, Tesla, Microsoft, Apple. They were still doing well. Now, a few of those stocks still are, but most of the stocks I just mentioned are not. So when we look, for example, at something such as Netflix, Netflix is now a disaster stock situation, completely crashed. Now, it crashed in January, and it simply crashed again last week. Facebook crashed in January, and now it's made a new closing low on Friday. And Google is also now broken down. It took out the lows of the year on Friday. It's at a new almost a 52-week low. I mean, the May low is 2250. We're not that far away from it, but all the support levels are essentially taken out. Now, when we look at the others, Amazon, it broke down, but it's not doing as bad as the others. Apple is still acting stronger. It's still above the 200-day moving average, the green line. And of course, Tesla is now the strongest, I would say, really popular fad stock in the market. Now, these FANG stocks, they so heavily weight the Nasdaq and the S&P that they have a big influence on them, and them doing well up until recently as a whole was what is enabling the stock market averages to kind of hold up while the internals in the market and ETFs such as ARK did so poorly. Now that situation is changing when you see Netflix, Facebook, Google now trading weak. That's a dangerous sign now that the stock market averages are likely to start to perform as bad as the rest of the market has been doing. And hence, this is a time to be very, very cautious. Now, again, what we have essentially seen this year was a rollover in January, an intensification of the selling in February and March, and then a rally back up to the 200-day moving average in March that stalled out. We came back down and then tried to pause and hold and bounce last week, and that was a failed rally. And now it looks like we're heading for the lows. So that's what's happened. But what's more important is what does this mean? How do you interpret this? Well, any market, any stock, any ETF has, you could say, has a trend to it. It's either in a bull market, a bear market, or something in between. And daily price action is only important when you understand it, interpret it according to what that large trend is. So when you're in a big bull market, what tends to happen is the prices stay above the 150 and 200-day moving averages. And those moving averages act as great buying opportunities. And you will get typically in a bull market, even when the strongest of years, you will get one or two pullbacks to that 200-day moving average, which typically brings some panic in the market, some skepticism and fear about whether it is really a bull market or not, spikes in options indicator such as the VIX that measure volatility in the options market. And these are great buying opportunities. In a topping market, internals fade, which is what we saw last year, and meaning that more stocks start to actually fall in the averages than go up, but that is masked by the fact that the averages are still going up because it's weighted by winners. But there's an intensification in volatility. The moving averages momentum starts to peak and then starts to roll over. And then when you tip into the bear market, the averages plunge below those moving averages, below the 150 and 200 day, just as we saw occur in January, February, March. And then you will get a rally back up, but those moving averages then act as resistance in a bear market, which is exactly what they are doing. And until that ends, you've got to be extremely careful of buying or holding anything trading below 200-day moving averages. And I do not care what expert comes on CNBC that is a fund manager that's dependent on the market going up to make more money, because they make money on management fees, gathering more assets. They want the market to go up. They want to believe that it will go up all the time. They don't want to say anything that might cause someone to sell. And CNBC doesn't want you to tune out of the show. They want you hyped up. But so do all the stock market gurus who want to sell you trading systems, or worse, crypto coin gurus who want you to buy garbage, virtual securities that don't pay a dividend, that have ownership in nothing real in the real world. So we're in a situation in which over the past 2 years, there was an upsurge, a multiplication of gurus pumping cryptocurrencies in garbage stocks and ETFs. And now that these things are below the 200-day moving averages, you cannot listen to these people and do well in this market. You have to tune them out. You've got to ignore them. And when the stock market has an up day, like it does Tuesday, all these people come out of the woodwork and start predicting this new thing, this new rally. They say, like Cathie Wood does, inflation's peaked, interest rates won't go up that much, and people buy into it. And then a couple of days later, the stock market just dumps. Why? Because that's how it trades in a bear market. The trend overall is down. Now you get bear market rallies, which we had in March when the market rallied back up to the 200-day moving average. And the fact about bear markets is, historically, if you go look, the biggest up days, single up days for the Nasdaq and the Dow were actually, the bulk of them were in bear market cycles from 2000 to 2003 and in 2008. Why? Because bear markets generate big stock market volatility. It makes them very difficult for people to make money in, because they have such crazy swings, crazy one-day moves up and down, and that a lot of them are fake outs, like we saw on Tuesday. And the entire rally from March back up to the 200-day moving average was a trap. And now people that have bought since that March low have essentially been trapped by the decline on Friday and are sitting on a loss. In other words, just about every single person that has bought in the past 4 weeks is now sitting on a loss, because the market dumped on Thursday and Friday and created, ruined the rally attempt. But let's step back. We're only looking at what is essentially short-term price action. And everything I've said, I'm not trying to suggest that we're going to take out that March low and then the stock market is just going to crash in some sort of collapse because all of a sudden everyone's going to panic. No, unfortunately, I wish this would end quickly. Unfortunately, I think we're set up for something a little bit different. And this, the point of this chart is to show you the importance of the 200-day moving average. The fact that it's when it's support during bull markets, resistance in a bear market. So what do? You To be a winner, you understand that and you take that very seriously. You don't hold or buy things now like the ARK ETF. Instead, you look for things that are trading above the 200-day moving average, and you buy them on dips. And there are things like that going on now. And I got, everything I've said does not mean I'm in cash. I've got 80% of my money just about is long. Now I've hedged a good portion of it because I think we got a risky market, but still I've got a lot of commodities. I got REITs, I got mining stocks, I got gold, I got silver. And these things I own are all above the 200-day moving average. But let's step back. Let's step back to try to figure out how this could likely play out. Now, this is a chart going back 10 years on the S&P 500. And I want to point out something to you on the chart. Now, I have on this chart the 200-day Bollinger Bands. Those are the pink indicators, and like an envelope around the S&P 500. Did they measure volatility over a 200-day period? That's a long-term indicator. And what's interesting about this is that if you step back, forget about what's happened last week, last month, even this year, and put that action in context of what happened in the 100 days preceding all that, what you actually see is that the S&P 500 right now is basically where it was last year around June. So we had a rally in November that stalled out and a drop in March that led to a move back up into the middle of this price range. And we're right now, in fact, in the middle, sort of in the price range, if you take the recent high and the recent low. In other words, one way to interpret the market is that the market has been in a range, causing the 200-day Bollinger Bands to come close together. And the indicator on the bottom of this chart is the Bollinger Band width indicator, and it's doing something it rarely does, and that is it's been falling for almost an entire year. In other words, the 200-day Bollinger Band has been coming close together for a year. That means that when you look at the volatility over a 200-day period, it's been shrinking. And the last time it did that was in 2014, when the stock market itself had a similar situation and went, it was up in this powerful uptrend in 2014, and that uptrend stalled out, and then it went sideways for close to 10 months, causing those bands to come together. The volatility was extremely low. At that time period, even the intraday movements were small, and then volatility exploded and the bands grew wider, and you had a flash crash event that August in a 20% correction in the S&P 500. The Nasdaq fell worse. Bitcoin completely crashed during that time too, just as it did in 2017, 2020, 2018. When the stock market pulls back, Bitcoin crashes completely. So Bitcoin is like the worst thing you could have in your account now. In fact, one of the implications of this chart is that the volatility in the market that we've seen is simply going to increase dramatically for the rest of this year. And when the stock market gets more volatile, Bitcoin gets more volatile. So when the stock market has down days, Bitcoin falls more, down months. It's the worst, in this type of market environment, it may be the worst thing somebody can have or own. But again, I'm not saying the stock market is going to crash, because one thing that often happens with these 200-day Bollinger Bands is when they narrow and then the market actually breaks up to the upside, is it will ride the band up. You saw that in 2020, you saw that in 2019, you saw that in 2017, you saw that in 2014. But in a powerful bear market, the opposite can happen. Those bands can go down, can widen, and the market ride the band down. I think that is likely to be what we see happen for the rest of this year. And to give you an example of this, the DBA ETF, which I now own a position in, you can see how it was in a bear market until 2020, and the lower band acted as support and it kept riding it down. I think something like that is what we're going to see the stock market do. Not for as long as it did here, but it could do that for 1 or 2 years. And why? Because we're in a combination of the 1970s and the 2000 stock market bubble. The 70s defined by high inflation and rising interest rates. The 2000 defined by a bear market and the most highly valued stocks. Not all stocks collapsed or crashed in 2000, but internet stocks did. However, utilities went up. Gold bottomed in 2000 and went up in a bull market that lasted for 10 years. Energy stocks did well, and so forth. And now we're seeing inflation, and we're in a raising yields cycle. And those two fundamental factors are the biggest fundamental drivers of all these chart trends that we're seeing. So again, I think what we're going to see now is the S&P, the Nasdaq hit that lower 200-day Bollinger Band, now trading at 42.19, about 50 points away for the S&P 500. Not much of a decline from here to get there. It wouldn't even be as much as the market fell Friday, about 1% more. But I think we're going to see, some chopping around, and then that's going to become support as it, over the months and weeks to come, we see it trend down. And this actually has already taken place with the ARK ETF. So you can see how now the ARK ETF, now the market's not going to fall as bad as this, because this ETF is made up of the most overvalued, speculative, in a lot of cases, junk companies. And what has it done? The 200-day Bollinger Bands squeezed towards November, and then this broke down, and now it's riding that 200-day Bollinger Band down. The bands are expanding, and the lower band is now support. And this thing is a disaster, and it's heading for 30 or something, or one day it's likely to cease to exist because so many people will sell it when it's in a bear market and give up, just like they did on the Janus fund after it peaked out in the year 2000. History does not repeat exactly in the financial markets, but it rhymes. So you can always see things sort of repeat. And the ARK is just like the Janus fund was back then, a fad fund that so many people got into, in 2020 on the way up. But another thing that broke down around the same time, but it's not like in some complete crash collapse like ARK, is the Russell 2000. And the Russell 2000 is more important than the ARK ETF because it's made up of 2,000 stocks. It's an entire index. And it's now also riding the 200-day Bollinger Band lower. So when you look at this, the 200-day Bollinger Band is sort of like support, and the 150-day moving average is now resistance. I think that is the future of the Nasdaq and the S&P 500. I think they're going to start to trade like the Russell 2000 has done for the rest of this year. So I think that's what we're looking at in the stock market. Now, another example of what I'm describing is a slow motion bear market, not one of a complete crash collapse, but one where you have a leg down and then it bounced back up. Like, well, that's what we saw basically play out in the first quarter with the rally failed. And I think that sort of thing is going to play out again and again until finally, people truly do give up on the stock market. But how many people do you know in the stock market are selling? How many people do you know that are telling you, I bought these crypto coins and I'm underwater, or I bought the ARK ETF and I'm underwater, I'm just going to sell it. Like, I can't make money in this. No, they're holding on. They're listening to the predictions. They're finding hope when there's a single up day in the market, and then denying themselves that the trend is down, even when the rally ends up failing. And it's done this more than once since Thanksgiving. So this is the yen, and forget about how it's been crashing. When it broke 80 to 73, that is like a crash. But you can see, this has had two legs downs up until the complete breakdown below 80. I think that's the way we're going to see the market trade here. And right now, I think we're in the process of starting a leg down. I'm looking for the Nasdaq, the S&P to break out, to break down, break through, break below the March lows and have a leg down. The S&P, the Nasdaq could end up down 25%, 22%, 20%, or something, and then have another sideways bounce. That's what I think we're looking to see this spring. And the next low may come when the Fed, raises rates 50 or 75 points in a single meeting. I don't think the low will come unless it's a very short-lived low as possible. But I mean, one that lasts for months, I don't think it's going to come at the next meeting in May, but it could happen in June or July. We're just, I can't predict, like that far ahead. It's not so much about predicting, it's about seeing how things look every weekend and then analyzing how things are lining up. So this is the market averages. It's very difficult to make money in a market like this. It's not easy to try to jump in and out, and it's not easy to try to short and bet against stocks. It's just a difficult market, and anyone who's telling you otherwise is kidding you. So what do? You look for things that are beating the market averages. You look for things that are in a bull market of their own, and you buy the dips in them. And as I mentioned before, when the Nasdaq peaked out in the year 2000, and all these internet stocks crashed, gold started a bull market. It made a major secular bottom in the year 2000 and beat the Dow and the Nasdaq and the S&P 500 for the next 10 years. And now the commodities made a secular bottom in 2020 and have been outperforming the stock market ever since then. And on Friday, they outperformed the stock market again, because what you're looking at here is the Commodity Research Bureau Index divided by the price of the S&P 500. And what that does, it's a ratio. It's a relative strength ratio that compares the performance, the price performance of commodities with the S&P 500. And when it goes down, commodities are lagging the S&P 500. When it goes up, commodities are beating the S&P 500. And just like we can do with the stock and think about the 200-day moving average as being, an easy way to figure out whether you're in a bull or bear market, we can do that with this ratio. And when we do that with this ratio, it's very easy to see on this chart that this ratio was in a bear market until it made a final bottom in the year 2000. And then it's now in a bull market as this ratio is trading above the 150-day and 200-day moving average. and those moving averages are now starting to curl up. So if you want to make money in the financial markets, the way you do it is align yourself with this chart, this trend, which simply says commodities are outperforming the S&P 500. Now, what you do or how you trade that, there's hundreds, thousands, perhaps endless ways you could do it. The important thing is to figure out a way good, right for you, and to do it. So one way one could do it, and I'm not doing it, and I don't suggest you do it, is get involved in commodity futures trading. Now, that's how Jim Rogers made a fortune in the 1970s. Now, I'm not doing that. I'm not saying you do that. I'm just saying that's one way one could do it. One could become a commodities futures trader. And to do anything like that, you would need to read books, understand the futures market, and dedicate yourself to learning how to trade that and take it very seriously. The age and time when you could just get on a message board, the Wall Street Bets board, or read people on Twitter and just buy what they're doing is over. That works when the market is in a bubble rally, but when you're not, that is going to lose money. So so in other words, you could be a gambler, not really know what you're doing, and then made money. But now that type of behavior will cause financial losses. And if you take big risks, which futures trading is, you wipe yourself out. So you got to now take whatever it is you're doing very seriously in the markets, or you are going to lose money when you're when the S&P and the Nasdaq is in a bear market. Most people lose money because they don't take this seriously. So another thing you can do, you can buy gold and silver. You go and buy physical gold and silver because gold and silver is part of the metals market. I'm doing a little bit of that myself. You can buy energy stocks, which I'm doing. You can buy mining stocks, which I've done. You can buy gold and silver ETFs, which I've done. So many things to do, but the important thing is that you need to do today, if you've not already done so, is understand how important this chart is right here. And this is the trend to make money in the markets. The simple fact that commodities are beating the S&P 500. And this is not just something happening, this week, but this is a secular trend change. This was a bear market for over 10 years and made a secular cycle low, and is likely to be a trend that continues for the next 5 years, 7 years, perhaps 10 years. This is the way to make money in these markets now, buying things, going long, and so forth. The easiest way to go long in a sector, a market, anything, is just to say, I'm not going to go on margin. I'm not going to take big risks. I'm just going to put 20% of my money in this with this bet. So for example, let's say I was a person that had 60% of my money in a Vanguard fund that is tracking the US stock market. Now that fund is going down, and I've had 40% of my money in bond funds as safety, and now those funds are going down, and now I'm losing money, even though I was told that this is safe investing and this always works by people who say they back tested it and this is just what you do. Our back testing proves it, when they are actually telling you a fib, because their back testing models are only good until 1980. And if you do the same back test in the 1970s, that investment strategy was an absolute disaster, just as it has been over the past couple months. It's been an absolute disaster. But let's say you're one of these people that has 60% of your money in a stock market fund, 40% of your money in bonds, and what you could do is simply say, okay, I think commodities are in a bull market. I'm going to sell half of my bond fund and get 20% of my money out of that and put 20% into a couple ETFs. ETFs such as the ones I own, DBA, XLE, GDX, CEF. You could put 5% in 4 ETFs. DBA, that's an agriculture ETF, GDX, a mining stock ETF, XLE, an energy ETF, and CEF. That's a fund that holds physical gold, physical silver. And now you're aligned with this trend with 20% of your money. Now, why do I say 20% of your money? Because if you go beyond that in anything, what often will happen is a dip, a correction will shake you out. And 20%, it's easy to hold and forget about it. And when you do that, little corrections or bigger corrections of 10% don't really matter to you. So these are my thoughts this week. This is going to be an interesting week to see what happens with the market. Crazy times we're in, and but there's no reason to think that what's happening in the economy with inflation, with rising interest rates, and these things you're seeing around you is ending. It's only beginning, and it's only been evident for people for the past couple of months. But this is the chart. So here's the thing. If you like this information or find it informative, you want to see another video, hit the like button, and then YouTube will tell people, look, this information is good. And they'll show the video to other people. That encourages me to make another one. And then hit the subscribe button, and then hit the bell next to that, and YouTube will send you the next video as soon as it is up. And have a good trading week, and I'll be talking with you later.